Well, hi, everybody. I'm Rick Edelman. Thanks so much for joining us for this webinar today. This is going to be really interesting. If you're wondering how you can take advantage of the variety of investment opportunities in the growing asset class of crypto, digital assets, blockchain technology, that's what we're going to provide for you in this conversation. And helping us tackle all this is Chris Rhine. Chris is the managing director and head of liquid active strategies for Galaxy Digital. Chris, great to be with you again. Thanks for joining us.
Thanks for having me, Rick.
Chris has been in the financial services industry for more than 20 years. Prior to joining Galaxy, he was at Cohen & Steers and at BlackRock. And Chris, you are one of many folks who are proving the trend of a lot of Wall Street executives moving to crypto. I have never seen anybody in crypto move to Wall Street.
Yeah, actually, quite a number of people at our firm started in traditional Wall Street firms that everybody's heard of. And though the pace really slowed down in 2022, 23 with the weakness in crypto prices, we've actually seen that start to accelerate again.
Galaxy is, I will call it a household name in the world of crypto. I'm not sure it is as well known outside of that. So tell us about Galaxy Digital.
Yeah, it reminds me of when I started at BlackRock back in 1999, and nobody knew who BlackRock was. But Galaxy, we have three distinct lines of business in global markets, asset management, and digital infrastructure. In global markets, we have a sales and trading business and a banking business. In asset management, we run a number of different types of investment products, from venture to active investing and passive investing. And in digital infrastructure solutions, we have a very large data center in Texas, scaled up to about 800 megawatts, that does Bitcoin mining, and is also one of the facilities looking at optionality in using some of that energy and capacity for high performance compute. The business is growing. Currently we have, it says 450 employees. We're probably closer to that 500 employee mark at this point, with offices around the world.
Galaxy Digital, one of the oldest in this space, one of the largest, and one of the most highly regarded in the industry as well. So I'm really glad that you're here to delve into this topic with us. We are going to have a really great conversation, and I invite your questions as well. If you have, many of you already did send us in questions, and I'll pepper them through the conversation. I'll feather them in as Chris and I chat. If you have questions from anything that comes up during this webinar, feel free to post it into the Q&A box here on Zoom. I'll be curating those as we go, looking for your questions, and I'll be feeding them to Chris, whether he likes it or not. Let me just begin, Chris, with the most fundamental of all questions we get. We had several folks ask about this in the registration process. One of the big stymies is that despite all the attention that crypto is getting and all the investor engagement and the new ETFs that exist in the marketplace, the fundamental question remains: what are the use cases? What is this good for other than speculation?
Yeah, and it's a question that I get asked from institutional investors and even, people that I meet on the street, retail investors. And, I think there's a couple caveats to that question. And one is we live in a developed world where things really work well. We have great companies that have built great products, and we've learned to really rely on these companies and products to be able to go about our lives, from having banking services and payment services that are electronic and fast and easy to use, and even being able to trade equities. Most of us now are able to trade in a brokerage account at sometimes just zero cost. Where we've really seen use cases develop first have been in some of those regions and economies where they don't have the infrastructure we have. So in Latin America and South America and certain, Southeast Asia countries, we're seeing a lot more of the use cases around kind of payments. I've heard weird stats that, of course, I can't back up with real data, that you even have fishermen in Brazil that use crypto payments and stable coins to conduct their kind of commerce. We're hearing of, different types of companies in Mexico that are doing foreign currency transactions that in many cases are 1/20th of the cost of what it would be if you go to a traditional bank. And I think when you look at kind of, America and Europe in general, you have large incumbents and they don't want to lose that business. They make a lot of money there. And we continue to see good technology in other regions that I think eventually will work its way into the Western world. It's just been a bit slower.
Yeah, I think that's a valid observation. I mean, we are the biggest economy of the world, obviously, the most important on the world stage in so many ways. Yet, out of the 8 billion people on the planet, we're only 320 million of them. Most people live in countries that either have an unstable government or an unstable economy or currency or both. And they are turning to crypto as a way to protect their money when you're dealing with 1,000% inflation, when the price of bread triples on a daily basis. You want to know that the money you've earned at your job is not going to be worthless in 24 hours. And so people are turning to Bitcoin and other digital assets, stable coins and the like, to protect their earning power. And that's something we in America couldn't care less about. It's just, we're complaining about, 5, 6, 7% inflation over the past couple of years. We've never experienced 1,000%.
Right.
And
I
I
think
think
that's
that's
the interesting thing with crypto and the use cases. I talk very much about kind of payments and using the technology and kind of the infrastructure. Bitcoin, of course, more of a store of value, another use case on its own, but definitely important in regions that you've mentioned, where if you can have an instrument that is priced in dollars and you're seeing just massive deflationary pressure in your currency, it's actually easier to buy Bitcoin in many of these countries than to buy many other financial assets.
wow. And that's something we as Americans don't really give any thought to. I
Yeah.
remember going to Portugal on vacation a few years ago, and whenever I go overseas to a foreign country, I love talking with the locals about their economy and incomes and just, what's life like from a financial perspective. And I asked a guy over there, tell me about your stock market. And and he said, yeah, we have, pretty good stock market. And I said, how many stocks trade on the Portugal Stock Exchange? He said 12.
Yeah.
And they were all banks and utilities. That was it. So I'm like, that is not something we and Americans are used to.
Yeah, in many countries, they're banks, utilities, or energy companies, or natural resource companies. And nobody in those regions have NVIDIAs of the world or Google. So they don't have these high growth investment vehicles that, we take for granted, having access to companies that have this, outsized growth potential. For many of them, Bitcoin is their growth and it is their momentum vehicle.
I was chatting, I was at an event a couple of weeks ago, and Mark Warner, senator from Virginia, head of the Senate Intelligence Committee, and Michael Saylor were both there, and the three of us were in a conversation. And Senator Warner, being a Democrat, most Democrats are not huge fans of crypto. He's not largely opposed. He is largely uninformed. And he acknowledged that in our conversation. So he asked Michael, he said, there don't seem to be very many use cases, which is the common objection that people raise. And my retort was, add the word yet. When Alexander Graham Bell invented the telephone, the first person to buy it was like silly because there was nobody he could call.
Yeah.
And so do you feel that the use cases and the opportunity for this to be applicable in commerce and in consumer behavior is going to grow over time? And how long do you think that's going to take?
I think it's going to grow significantly. And, I think there was a lot of expectations a little bit too quick in tech. And I think that's common is, in the short term, and this is a famous quote that came from, I think it was Andreessen, that in the short term, we overestimate what can be expected from tech, but we underestimate in the long term. And
Yeah.
when we look at kind of where we are in the cycle with crypto, you had a massive amount of capital that was put into venture investments in the last cycle. Some of that stuff is just coming to fruition today, and some of that won't come to fruition for the next couple of years. But that's because it isn't something that happens instantly. And in a new technology, there's a lot of product market fit and sometimes product failures. And we saw this really in the tech bubble back in the late 90s. There were many companies that were just a little bit ahead of their time that didn't work out. But now we look at kind of what those companies were offering 25 years ago, and they're completely available today.
Yeah, and so the real question is not, are you going to own this? The question is simply, when are you going to choose to own it? You know, we all had the chance to buy Amazon in 1999. I don't think any of us did, and maybe the few who did sold it when the bubble burst in 2001. And now we regret that we didn't own Amazon back then. You didn't own it back then because it was absurdly volatile, incredibly risky, and unproven technology, uncertain in its market dominance, et cetera. Today, everybody owns Amazon. If you own a stock fund, Amazon is inside it. And so it's not a question of whether you own Amazon. The only question is, when did you choose to invest in it? And that's where I think we are with crypto. Tell me if you how you feel about this comment, that investing now before the use cases are in place is how you're going to maximize the profit, should that profit ever come. If you wait until after the use cases are there and it's obvious,
Yeah.
much of the profit will already have been obtained, no?
I think that's the case with every investment, is that if you wait for full information and everybody knows, well, then it's already kind of reflected in the price of that asset. And, you know, coming from an equity investment background, you can't wait for 100% certainty because you miss the opportunity. You have to look for clues as to what that opportunity is. You have to make your own assumptions and forecasts as to what that, you know, total addressable market might be and how these different protocols or crypto protocols will fit into that opportunity. And, you know, you have to do that on 60% knowledge, because if you wait until it's 100%, you're not going to be able to capture a bulk of that gain.
And so the answer, I think, is not don't invest yet, wait for more proof. It's the correct answer should be instead, limit the amount you invest. This is why you don't put 30% of your money in it, but to do zero is equally flawed, no?
Yeah, that's right. And I think that makes sense in an asset class like crypto, where volatility is still very high. You know, you have to right size your investments based on the contribution to risk of your overall portfolio. And with the current volatility of different equity investments, you know, I would definitely keep that to you know, a manageable weight, not 30% of your portfolio.
So how would you define manageable?
I think, you know, it depends really on a lot of characteristics with the investor. Younger investors, of course, they tend to have a lot more time on their hands. They tend to be a little bit more growth and aggressive in their investments. Older investors, they're looking more for stable income and they're looking for a little bit less vol. So most of what we've seen in terms of, you know, the different charts of how crypto will impact your portfolio, a lot of that is between 1 and 10%, and I think a lot of people are kind of staying between that 1 and 5%. But we've seen, you know, investors in Asia putting 10% and more of their portfolio in crypto.
But I think that's probably also because they don't have as many options or opportunities in
That's right.
diversity that we have here in the US. But
That's right.
even that young, aggressive investor, only 10, I mean, that says a lot about the asset class. And that's really, I think, the big point. Don't assume that you should be doing zero. We should be doing non-zero.
Yeah.
Whether that's 1 or 5, leave it to you and your clients. But it shouldn't be zero. So you mentioned the second big thing. You know, we've talked about the use case scenario. The other two big objections or concerns that advisors and investors raise, you named one of them, volatility. The other one is regulatory risk. Tackle both of these. Talk first more about volatility.
Yeah, so I mean, volatility is still quite high. And it doesn't matter if you're looking at the equities that are associated with crypto, the tokens that are associated with crypto, or even some of the derivatives associated with crypto. You know, over time, we have started to see the volatility of an asset like Bitcoin drop, but it isn't dropping incredibly fast. Now, part of that is due to market structure. Part of it is because this is the only real 24/7 asset out there. So there are definitely going to be periods where liquidity is quite thin, and then periods where liquidity is quite rich. So if there is a sharp move and there's not much liquidity, it can have an outsized impact. The other thing that we've definitely seen that's impacted crypto prices is the way that many investors have applied leverage, and how that leverage can be unwound automatically on some of these platforms as certain price levels are hit and additional margin isn't added in time. So I think ultimately, as we continue to see investment into these ETF products, and especially if we get an options market developed around the spot ETFs, it's only in the long term going to help to continue to drive down the volatility of the asset over time. And I think that's going to help make it a little bit easier for certain investors to get engaged.
Well, let's elaborate on that. We have the Bitcoin ETFs came on the market in January, the Ethereum ETFs this summer. Now BlackRock has obtained approval for a Bitcoin options trading on the ETFs. Their proposal for the Ethereum options have not yet been approved by the SEC. Talk about what that means. Why is BlackRock interested? And I'm sure others will follow suit. What's the point? What's the motivation to create options trading on this, and what is the impact going to be?
I think the point is very similar to what you see in any equity, to be honest with you. You can buy options on, many different types of, securities. And what it really helps to do is to manage your risk profile better. And, I was talking to a good friend the other day, and one of the things he would love is if Bitcoin had a yield. And I said, well, once you have kind of options on your spot ETF, you can create a synthetic yield by selling out of the money call options. Because you're still dealing with an implied volatility of anywhere from 50 to 60%, you can generate some really significant call premium on that and still allow for another 20 to 30% upside, depend on the strike that you set. So you give yourself room for capital appreciation, and you're creating this synthetic yield as you kind of are writing those options, which you can use as the income component. So there's a lot of things you can do. You can create, more riskless positions with straddles, in terms of how you want to fund for your calls or fund for your puts. And it just gives an investor a lot more flexibility as to how they want to position in the asset.
Which will translate to more and more people engaging, particularly institutional investors who are used to this kind of sophisticated investment activity. And as more and more come into the marketplace, that can only mean, and it's a classic supply-demand equation, more demand has to translate into a higher price because the supply is fixed, no?
That's right. Yep.
So talk about the other half of that question I posed to you. We talked about use cases and volatility. Now tackle regulatory uncertainty.
Yeah, so this has been, one of the biggest concerns from larger investors is just what's going on the regulatory side. And I think when you look back, much of this stemmed from the collapse of the FTX exchange back in November of 2022. Not only did it kind of hit confidence with investors that all of the capital on that exchange could essentially be confiscated and claimed and in some cases wiped out, but we saw a very strong response from the SEC in Q1 of 23, very much targeted at crypto companies. And that's when we saw a lot of SEC lawsuits that were lobbied against Coinbase and a number of other firms as well. So we spent most of 2023 in what I would say a regulatory stranglehold. And there were a lot of prominent Democrats. I wouldn't say a lot. There were a number of prominent Democrats that were very anti-crypto. As we've gotten into 2024, we've definitely seen a bit of a thawing out on the regulatory side. In 23, you could count on one hand how many conversations were taking place in Congress, either in the House or in the Senate, around crypto. And I don't think anyone had time for crypto. Nobody cared. In 2024, we've seen a big shift on that. You're seeing, a number of different meetings that are scheduled around crypto, around the need for crypto regulation. Even Maxine Waters saying we need to strike a big deal on kind of stablecoin bill. We had SAB 121, which was a bill that would deal with how banks can custody crypto and how that crypto custody would be treated on their balance sheets, actually passed in a bipartisan support within Congress. It was ultimately vetoed by Biden, but we're seeing a lot more Democrats move to more of a pro-crypto stance from kind of an anti-crypto stance. And the Republicans have definitely been a bit quite a bit more positive. But having more of these Democrats, and in some cases, people like Chuck Schumer, who are quite powerful Democrats, be more supportive of crypto has been very refreshing. And I don't think this is just an election issue coming up. Clearly, Trump has been very vocal and clear about his stance on crypto and his stance on wanting to fire Gensler immediately. But we've definitely heard from Harris's advisory, group that her stance on crypto seems like it's going to be quite different from the current administration in the White House. And even though she's VP there, I think many people know that the VP is not really a role that has much power. And I think we have to remember that. So we have a number of people on the ground in DC. We've had a number of conversations with politicians. And I think regardless of who wins the White House, we're moving in a much better position in terms of the regulatory approach towards crypto and the opportunity for real regulatory approvals in Congress that will set the stage for how regulators regulate it.
Yeah, I think that the influx into the crypto community of former Wall Street executives, people like yourself, are providing, I'll call it adult supervision in the room. Historically, you go back 10, 12 years, the crypto community were just a bunch of crypto bros. They were technologists. They were folks who were really not engaged, not familiar with how the financial services industry operates or the regulatory regime. And they were in over their heads, quite frankly. Now we have folks throughout the industry, people like you, who understand how the game is played. You cannot try to defeat the SEC. You have to work with the SEC and Congress and the White House to get where you're trying to get. It's not a question of yes, no, it's a question of how. And now that there are so many executives, they have all come to realize money talks in Washington. And so now this year, we've got how many? Half a dozen super PACs amassing over $200 million in campaign contributions that they are throwing at candidates who support crypto and against candidates who hate crypto. And that, I think, is what's catching the attention of the Democrats who have been largely opposed. And it's forcing them to reconsider their ideological stance. And if they don't come to terms with this in a stronger, more persistent way, they're going to suffer in the not just the 24 election, but the 26 and 28 election. I don't know if all this is good or bad, but I think it's the way that it is, and it's inevitable. No?
Yeah, I think you laid that out very well, and I think it's very inevitable. Crypto is becoming a larger and larger industry, and I think many people realize that we have to get past kind of this, FTX phase with SPF donating to all of these different, Democratic candidates and them wanting to distance themselves from it. And of course, the best way to distance yourself from something is to completely, shut something down to avoid. But time kind of heals old wounds. And as we kind of move away from that, the sentencing with SBF is done. We just had Ellison. We're kind of moving away and turning the page on that chapter. And I think that's also helping to kind of provide a better kind of forward outlook on the regulatory side.
Yeah, I think people are beginning to realize once again that just like Bernie Madoff didn't represent the stock market, SBF didn't represent the crypto market.
Definitely.
Okay, thanks for that background and foundation. I think that's really helpful for folks. Let's talk now about the pragmatics and the reason that we're all here today. Talk about the ways that people are investing in the crypto space. We've got the two ETFs, but those are just Bitcoin and Ethereum in a passive environment. So talk about all the other opportunities, such as, let's start with Bitcoin mining.
Yeah, definitely. And for anyone who wants to, we just published a report that takes a look at the entire investable universe of digital assets on our website. So feel free to head over there for a much more detailed discussion. But you're right. I mean, there are a number of ways to get exposure to investing in crypto. And many people, originally, they went directly on chain to get exposure. They were buying crypto tokens. They were custodying them in, self-hosted wallets. As more and more people saw opportunity, they started to create kind of these exchanges. And Coinbase is a great example, Kraken, Gemini, et cetera. And that allowed people to get ease of onboarding into kind of the crypto ecosystem, and they could buy tokens directly. And that kind of helped to launch, funds that were managing, liquid token portfolios. So you could have more investors hire a fund manager to do that. We saw then, as more and more activity was occurring, a lot of venture capital start to move in. So there's a number of venture investments, direct investments into companies. Again, venture funds were created. It was another avenue, and one of the avenues that we saw a lot of institutional investors enter because they know where to put venture funds in their portfolio allocation. You put that in your venture bucket. I guess, the third way, of course, now that we have these ETFs, is that people can really, or the fourth way, they can access it, directly through their brokerage. So you can buy ETFs directly through your Schwab account or your Chase account. And now there are more equities that are associated with crypto as well that you can invest in that get exposure and tend to follow kind of the price trends in the underlying price of Bitcoin or other crypto tokens. And you don't have to kind of get into that whole token argument and token custody argument as well.
The document that Chris mentioned, there's a terrific white paper and also some pretty cool charts, and we are going to push them out to you right here so that you can click that link and get access to these, make it simple and easy for you to do so. I really encourage you to read this white paper because it will give you a lot of really good content on what's available in the marketplace. And the two charts that are attendant to this are really worth taking a look at as well. Talk about Bitcoin mining, because when GLD came out years ago, the first gold ETF, a lot of people said, yeah, I can buy gold, but wouldn't it be cool to own gold mining stocks instead? And that's kind of where we're at with Bitcoin versus Bitcoin mining. So talk about those differences.
Yeah, I think the gold example is good. And I used to run a global natural resources portfolio, and you have the commodities and then you have the equities that are helping to produce the commodities. And the way that we always saw that is the producers, they tend to have a little bit more beta than the commodity. And over a long period of time, they tended to have better return profiles because these companies were working to create value. They were growing their portfolio of assets. They may have had increased retained earnings or dividend payments. So when you look at long-term total returns, in many cases, the companies that were producing the commodity were outperforming the commodity itself. And when you look at Bitcoin mining today, in the US, we have seen US-based miners, especially public miners, they have been really procuring more of the global hash rate of Bitcoin mining. More and more hash rate has been moving to these big public US miners. And I think there's a couple things that really benefit them from having these large facilities, having from scale, being able to source power at very cheap prices. And what we're trying to see over time is, the investments in the core mining infrastructure tends to be quite high. Longer term, can you procure enough margin and cash returns to justify that investment? And does that translate into a stock price over time, which outperforms that of the commodity?
You mentioned hash rate. For those who aren't familiar with that, explain that.
So hash rate is essentially when a Bitcoin miner is mining, they have a specific hash rate. It's kind of like their computational power. So think of hash rate similar to an oil producer as the barrels of oil produced. So it's the speed at which they're producing barrels of oil. And all of that hash rate then is aggregated into the Bitcoin blockchain. And if you have more and more miners contributing hash rate, then the total hash rate will go up and up and up. And of course, what happens then is the hash price, the price that miners will receive, will come down. So as kind of Bitcoin miners are increasing their hash rate, and that's impacting kind of the global hash pool, the price will come down. And this means that more scaled and economical miners are going to be the ones that can benefit, and your subscale miners will drop out, similar to what you'd see in an energy producer. Those that don't have scale, those that have high cost assets, they're going to end up kind of folding.
And what it also means is that when you have a lot of hash rate, it means that you have a lot of electricity being burned. You've got a lot of energy being consumed, which is one of the criticisms of Bitcoin particularly. So talk about that issue of the energy consumption and the implications of the entire Bitcoin infrastructure.
Yeah, so energy is definitely been one of the biggest criticisms, I think. And I think there has been some information, and maybe some of it misinformation, on kind of the fact that Bitcoin mining is consuming a lot of carbon-based electricity. Many of the US public miners have been very, very focused on sourcing clean energy. And where we have pockets and pools of renewable power, many of these miners are very focused on making sure that kind of that carbon footprint that they have is much, much smaller than what I think many in the public think it would be, because they're consuming so much power. But I think, one of the things that has fallen into many Bitcoin miners' laps as a result of having already contracted much of this energy and having facilities and electrical infrastructure that can handle it is we're now entering into a point where you have many of these hyperscalers and other large companies that need data centers and they need power. And more of them are looking at Bitcoin mining facilities and saying, okay, you're making X% mining Bitcoin. We need energy, we need it now, and we need the facilities. What would happen if we would essentially give you a long-term contract to host our AI mining chips as opposed to mining Bitcoin? And it's a conversation that almost every single public Bitcoin miner has been talking about, and we've seen a couple miners actually execute on that opportunity.
And that is one of the most exciting trends that we've seen this year is the merging of Bitcoin mining and AI. The AI data centers have massive needs. They're projecting that it's going to be $100 billion, a 100x increase in the cost of providing the energy that the AI data sets and large language models are going to require 10 years from now to do what it is everybody's expecting AI to do. And what's interesting is that you can't turn AI data centers off, because it's like, imagine suddenly your smartphone doesn't work because they turned it off due to bad weather. So the AI data centers have to be up 100% of the time, but a Bitcoin miner can turn on and off because what they're doing is a voluntary activity. The only pure person who cares is them. Nobody else cares whether they're mining right now or not. So bad weather, they'll shut it down. You can't do that to an AI data center. And so it's a really interesting notion of marrying these two technologies together. I don't think that was intuitive to a lot of folks.
Yeah, and I think, many people are waking up to this. We've seen a lot in the news with prominent, technologists and different CEOs talking about the need for, investment in the US grid. We don't have enough generative capacity for energy. We don't have the transmission and distribution capacity out there to really support a significant investment. And I think Sam Altman there was news out that he was talking to the White House about this and the need for investment, and of course saying this is a national security issue. And right now, I think China has more than 20 nuclear facilities under construction. For us to really get the power that we need to power the size of data centers that these companies are talking about, and to really provide, enough capacity to keep up with some of our, let's call them government competitors, a lot of investment is going to need to be made to make sure that we don't fall behind in the AI race. And it's not just the US, and I think a lot of reports, they look at kind of power needs and kind of AI from a US perspective, but Europe is going to need to do this. We're going to see power investments in Europe. We're going to see power investments in Australia. We're going to see power investments outside of China as well in Southeast Asia. So this is going to be a global phenomenon, not just kind of a China, Russia, US phenomenon.
So you'd mentioned earlier that you could buy Bitcoin or Ethereum directly, for example, from Coinbase, Kraken, and so on, other crypto exchanges. You could buy the new Bitcoin and Ethereum ETFs. There are now futures ETFs on the market. We now have the burgeoning new options products that are coming onto the market. There are crypto equities so that you can invest in publicly traded stocks that are in the crypto sphere, so to speak. And I want to elaborate on that element, I like to refer to as the picks and shovels approach of crypto. And just this month, well, let me back up and just say this because I think it's really relevant for everybody. Up until very recently, and I mean prior to this year, for the first 15 years of Bitcoin's life, you had crypto operating in this tiny little bubble all by itself. It's almost like its own little universe. And then you had TradFi, traditional finance, all of Wall Street, the massive machine of asset management operating on its own, and the two were not mixing at all. You were either in crypto or you were in TradFi. Maybe you did a little both, but they didn't coexist. Now what we're discovering, and you're leading the way here, Chris, at Galaxy, we're discovering that the two are coming together. And just this month, Galaxy has partnered with State Street Global Advisors, SSGA, one of the world's largest asset managers, with I don't know how many trillions, $4 trillion
Over 4, yeah.
In assets globally, one of the best known brands in the ETF world. I mean, SPY, I think that was the very first ETF, and certainly the largest. I think SPY by itself has about a third of the total ETF assets in the country. You've now launched with State Street 2 crypto ETFs, which I find astonishing. A company as huge as State Street, rather than doing this on their own, said, we don't have the in-house expertise. We need to partner with somebody in the crypto space, and they chose Galaxy. That says something remarkable about State Street. They know their limitations, and remarkable about Galaxy that you're the provider they turn to. So talk about these 2 brand new ETFs. They both launched on the 10th, like just a couple of weeks ago. The Spider Galaxy Transformative Tech Accelerators ETF and the Spider Galaxy Digital Asset Ecosystem ETF. Talk about both of these.
Yeah, happy to. There's actually a third, which is the hedged crypto ecosystem as well. But I can talk about the nuances. But we're really excited about the partnership with State Street. Our model has been to really partner with top tier firms that operate the ETF space with great distribution platforms. And we're thrilled to really work with them as a sub-advisor for these products. We spent some time really looking at the market opportunity here and where there's market gaps. And I think to your point, there's a lot more realization that you don't need to buy crypto tokens to get equity exposure. You don't need to invest in the private venture side of kind of the space to get crypto exposure. And that as this universe continues to expand and we see more S1s filed for companies to go public, and I think there's probably right now over a dozen companies sitting on S1s kind of waiting to see what happens with the election and the regulatory side that would really kind of continue to broaden out the universe of publicly available companies. It's going to continue to be a larger and larger opportunity and give us more opportunities to find what we think are going to be the companies that are positioned to benefit the most and where there's potential alpha opportunities to capture that. But in terms of the 3 products, transformative tech is a bit of a broader thematic. It's not just kind of a crypto thematic, but it's also taking a look at all emerging technologies. But instead of just focusing on the tech side of things, looking at the entire value chain that could be impacted, all of the downstream effects, regardless of industry. So when you look at that portfolio, we've been talking about AI and data centers. There's going to be a significant impact and need for electrical infrastructure. So we'll invest in electrical equipment companies. We talked about power. Power generation is a key theme. And we just had Constellation Energy Group talked about in the Wall Street Journal on Friday that they're looking at restarting one of the reactors at 3 Mile Island with a long-term contract with Microsoft, particularly for AI. And I think the day that stock was up over 25% in a single day. There are going to be other types of companies and industries that will continue to benefit from these downstream effects. And that portfolio will really be able to capture kind of that full ecosystem kind of from soup to nuts and allow us to better kind of manage not only the factor risk of the portfolio, but manage a lot of kind of that industry concentration risk as well, instead of it just being a very focused tech portfolio.
And so that is a broad exponential technologies fund, which has a large dose of blockchain, crypto, digital asset exposure as part of it, but it goes beyond crypto. That symbol, by the way, is TEKX for the Galaxy Transformative Tech Accelerators ETF, TEKX. The other one is the Galaxy Digital Asset Ecosystem ETF, and this is it not, purely focused on blockchain and crypto?
Yeah, this one, so we've kind of split this into two thematics. We look at it from those companies that are directly associated with blockchain and crypto. And then we also look at companies that are kind of getting into it on the fringe or second derivative, or maybe crypto is an emerging part of what they're testing. And the reason we do this is because we know that the volatility of the crypto space is quite high. And given that these are actively managed ETFs, I want to be able to really better manage the risk profile of the portfolio than kind of a standard, passive ETF that's just invested in Bitcoin miners. So if we see, the price of Bitcoin surge and Bitcoin miners are up, 100, 200, 300%, we want to be able to really take profits on some of that. And potentially, if we think the market's getting ahead of itself, we can de-risk into kind of these second derivative companies, which in the event of a significant price decline in crypto are going to be much more insulated from that. So it's a way for us to kind of create a portfolio that has the ability to navigate the market depending on where we are in the cycle, but still allow us to focus on where we see really great opportunities directly with crypto equities, and indirectly where we think crypto could be a growing part of their business model.
I think this is something really worth highlighting. Both of these funds are actively managed ETFs, allowing you, to the point you just made, of moving the money from one stock, one asset class, one sector of the asset class to another based on your expertise. That's not something you're going to get from a passively managed fund, which is simply tracking an index. And let's face it, the overwhelming majority of ETFs broadly, as well as the crypto ETFs on the market, almost all of them are passively managed. So what you're doing is really quite different.
Yeah, definitely. And I think, the third product is even a bit more differentiated, and it's taking that original crypto ecosystem portfolio, and it gives us the flexibility to write out of the money calls to generate option premium, and to buy out of the money puts to buy downside protection. And essentially, there are going to be investors that, even though we can navigate, they're still worried about the overall volatility of that ETF. And this one, it will take the volatility of that strategy down. And I think, in most cases, we'll probably end up generating some type of a dividend annually, just because my goal is to always have a little bit more overwritten than, spending on the put side. So it's dynamic. We don't have it fixed. It's not like a JEPI where it's very systematic. And if we think the markets look very cheap, we're probably going to be buying a lot less downside protection, and we're probably going to be writing less calls so that we can capture that upside. But again, if we think that markets have made a really significant move and things are looking a bit lofty in terms of valuations and prices, we can step up the overwriting as we're migrating things, and we can step up kind of the downside protection on the puts.
Kind of the overall approach to money management that State Street's well known for, and that Galaxy has really made a name for itself doing. So pretty consistent with all that. And I just have to comment on the timing of the launch of these ETFs. I mean, when you launch ETFs, you're just going about the process, getting it to market as you can, et cetera. Both of these two ETFs, TEKX, which is the Transformative Tech Accelerators ETF, and DECO, DECO is the ticker for the Digital Asset Ecosystem. Both of them launched September 10th. And we all know past performance doesn't predict future results, and we should never assume it does. But I just have to note this. The TEKX is up 18% in just 2 weeks, and DECO is up 15% in just 2 weeks. You just have to be smiling at that, I'm assuming, Chris, right?
Yeah, I mean, I won't comment on performance. I'm sure there's probably a compliance restriction somewhere, but anyone could look up the performance of these in their financial apps. But We definitely were tracking the decline in markets, and continually we've been running these models for a while, and we continued to see opportunities to keep tilting them a bit more risky. And that's how we started the hedged portfolio. We overwrote a lot less than where I think we would have had it been 2 months ago, and we bought a lot less downside protection because our view was there's quite a bit more upside here. And I've been very vocal with many investors that I think Q4 is a great setup for the entire crypto ecosystem, with just a number of catalysts that I see, positive catalysts that'll play out over the next 6 months.
Yeah, I know you don't want to comment on the performance. I will, and I'm sure your compliance department will be okay with what I'm about to say. Don't get giddy over the fact that it's up 15 or 18% in 2 weeks. Nothing is supposed to do that. And anything capable of going up that much in 2 weeks is capable of going down that much in 2 weeks, which goes back to the volatility conversation we had earlier. This is why people need to be serious about limiting their exposure to these assets, because of this incredible volatility. So yeah, I think everybody who was fortunate enough, and I'll say just out of dumb luck, bought it at the opening on September 10th, let's not assume you're going to make 15% every 2 weeks for the rest of your life. So I think we ought to keep all of that in mind and keep a level head about ourselves. And that is one of the big, here's a question that we got from one of the folks who's attending this event. Several months ago, he writes, there were many predictions, and I want to emphasize several months ago is how he opened his question. Several months ago, there were many predictions that Bitcoin would rise to hundreds of thousands of dollars. What happened?
I would say that everyone who's tried to predict a Bitcoin price at many points in their career has been very wrong. And that's why I have very vocally not been somebody who ever tries to predict the price of Bitcoin.
And certainly not in a period of weeks or months.
That's right.
I think I tell me if you would make this statement. A decade from now, would you expect Bitcoin's price to be higher?
I think it'll be substantially higher.
So, and that's kind of the point, isn't it? When this guy writes several months ago, I'm like, you got to be kidding me. You made an investment hoping to have an incredible gain in a few months. Nobody would expect that in any asset class. It's unrealistic. And if you do have that succeed, that's dumb luck. That's not intelligence. But a decade from now, that's a different story. And that's where we need to be focusing. So change several months to several years or even several decades, then we can have a conversation.
Yeah, and I would actually say the price action that I've seen in Bitcoin makes me much more constructive for the future. What really is very difficult to manage as a Bitcoin investor, of course, is that you get these periods of massive momentum and you get into these relative strength indexes that are, screaming hot and everybody's flying into it at once, and then everything collapses again. So for me, I love to see an asset that has moved up significantly and then has this period of consolidation, which is what we've seen with Bitcoin, kind of between the $72,000, $52,000 range. We've been consolidating ever since March. Even Nvidia had a big period of consolidation around that kind of $400, $500 mark. It didn't stop it from taking the next leg higher. It's just it had a very big move from the lows of 22 of almost 100 up to about 500. And then it had this period of consolidation where people that had made money had been able to kind of sell, people that didn't get in had been able to buy. And then eventually when the sellers were done, you took that next leg higher. And I think that's kind of the beauty of what we've seen here is Bitcoin didn't go to ridiculous levels. It went high as a result of kind of the spot ETF. And we've had this good period of consolidation. And it really makes me feel like we're kind of almost ready to break out of that consolidation and take that next leg up.
So this question, I think, really gets to the heart of the matter from one of our attendees. What is the best, easiest, and safest way to get long-term exposure to the crypto market?
I think it really depends on the investor as to what the best is. And I think, again, this goes back to what your risk tolerance is. I don't want to make a recommendation for, an investor that I don't even know the profile of. And, I'm a portfolio manager. The people on your call are going to be much smarter than me on this. They know how to deal with individuals' needs and, many people's, unique characteristics. But I think as an advisor, you have now more and more ways that you can access that. You can do it through, these spot ETF products. You could get just Bitcoin exposure. You could do a hybrid Bitcoin ETH exposure. You can look at some of the ETFs that are buying the equities. We'll take a look at what that opportunity set looks like, what the underlying volatility is, and just from my perspective, I think there's opportunity in all of these different ways, but you don't have to pick just one either. You can kind of divvy up your capital across a number of different instruments and think of it as kind of, in some cases, when I used to run portfolios, I couldn't tell the difference between, maybe 3 different healthcare distributors. I would just buy a little bit of all 3. And I'd say that's my healthcare distributor exposure. Maybe that's kind of to start how you think about crypto. And what that'll do too is that'll really create kind of that investment that helps you kind of stay up to speed on crypto. It educates you about crypto, and you'll continue to consume more material. And as you're consuming that, and your clients are consuming that, it'll give you kind of room to make more nuanced kind of allocations into things that you think are appropriate for each of your clients.
And so I think you're right. I think, we're all big fans in the asset management field, and certainly in the financial planning world, we're all big fans of diversification. So rather than trying to make a bet on a single stock or a single coin or token, better to be broadly diversified, and not only with what it is you're buying, but how you're buying them, such as the options trading and hedging and yield generating and so on, to reduce the risk that you're going to get wiped out suddenly overnight. And I think what is Warren Buffett's famous line, better to be approximately right than precisely wrong. And
Yes.
so I guess that's really what you're talking about, isn't it?
Yeah, I just think the beauty of being able to kind of approach this with different options, and I think that kind of gets back to a report, is you don't have to pick just one route. And maybe for certain clients, one route is right, but maybe for many others, it's kind of taking a look at the options and putting kind of a bespoke kind of asset allocation together that really helps kind of divvy up the risk, to your point.
Yeah. One question from somebody watching this today, the cost of the ETFs that you and State Street have put together, what are those?
I believe in the DECO and TechX, there's 65 basis points. And for the HECO, which is the hedged version, I believe it's 90 basis points.
And we have pushed out to you another link to a document at State Street that describes these ETFs in detail. So that information is available to you there as well. Some additional questions that we're getting, your views, elaborate. We talked about the fact that you're actively managing. So talk about your views. This person's asking on active management in crypto versus merely buying the Bitcoin and Ethereum ETFs.
It's a fantastic question. I love this question because one of the reasons that I think I got into portfolio management, and I've always had a bias towards volatile industries, is that volatility creates opportunity. And there are always going to be mispricings in volatile assets. We see it often. In crypto, it's exactly the same. There are going to be opportunities where even on the spot token side, you have just a significant run up in price that you should probably be taking advantage of and clipping coupons, taking profit on that. I think it always behooves us not to wait until the last minute to try and capture that, ultimate high. But I'm very much a fan of every 30% gain, regardless of what I'm invested in, take some profits and continue to do that. And, I used to own an AMD back in 2015 at $3 a share, and unfortunately, I don't own it anymore because it's like 150 or 160. But that was kind of what I was doing. I was taking profits on every 30% rise and ended up selling way too early, of course. But in kind of the equity space, I see that same type of opportunity where, because of the inherent volatility of crypto, the equities have a lot of volatility. In fact, I see even more volatility in some of the equities than some of the underlying crypto tokens. So for me, that just means that the market is ripe for active management. And I think the other really key point in the equity space, it is not followed well by the sell side at all. There are very few people on the sell side covering this. These are business models that in many cases are brand new. They're very hard to understand sometimes. And just having kind of the whole platform at Galaxy and exposure to the industry, we consume these products. We work with a lot of the companies. It just gives us an ability to really kind of beat the street and beat the market in terms of how we're seeing kind of opportunities for investment and where we should be kind of staying away from based on price and relative value and other factors.
This has been fabulous content and really insightful information, Chris. I want to thank you so much for doing this for us today. That's Chris Rhine, who is the lead on the liquid asset and active strategies at Galaxy and State Street with their new funds that they have launched at SSGA. I want to let you know that on Wednesday, October 9th, we have another webinar on this same kind of topic, the investment opportunities for RIAs in the world of crypto, where we're going to talk about yield, staking, lending, and custody to help you further educate yourself about what's available beyond just the spot ETFs. And if you are interested in those spot ETFs, Bitcoin and Ethereum, we have two toolkits, one on the Bitcoin ETF and one on the Ethereum ETF. They are free. The QR code is right there, so you can download them really quickly and easily. You'll get comparative charts that compare all of the ETFs against each other, so you can easily compare them. And you'll find a lot of great content and educational information there as well. And if you haven't already enrolled, do so now. Become certified in blockchain and digital assets. The CBDA designation is listed in the FINRA database of professional designations, and you'll be able to say to your clients that you are now fluent in this topic, not just on the investment side, but the technology as well. What is all of this? How does it all work? What about regulation, taxation, compliance? All of that in this online self-study course. Take it at your own pace. Join the thousands of financial advisors from 37 countries who have obtained their CBDA and both basic and advanced certificates. QR code is right there. And be sure to tune into my podcast every day, Monday through Friday, on crypto and all the latest in the field of financial planning and investment management. And be sure to read my Amazon #1 bestseller, The Truth About Crypto. Chris, it was just wonderful to have you here on the program. Thank you so much. I look forward to doing it again with you.
Yeah, absolutely. Appreciate it. Thanks, Rick.
Thanks, everybody, for joining us today.